First of all, good morning, everyone. Great to see so many familiar faces and indeed a few new faces this morning. This interactive panel discussion is focused in on the area of succession in business. And during the next 90 minutes, we intend to discuss and debate the different ways in which shareholders should consider preparing for succession in business. Whether that be preparing a business for a trade sale, whether that be potentially developing a management team within a business that can at some point in the future buy the business through a management buyout type transaction, or indeed whether it may be more akin to a transaction whereby a business is passed down, or indeed the ownership of the business changes to allow the business to become employee-owned through an EOT, or indeed maybe passed to second/third generation family members. During the course of the panel debate, we're going to consider the many different aspects that may impact and influence one's decision when it comes to planning for succession. And those key areas from our perspective will focus in on tax, value, how much value can one realize from their business when effectively passing the business on to a different ownership structure. Indeed, how one's legacy will be protected, the amount of time such a change in ownership may take, and indeed the execution risk of such a transaction not being successful. So quite a lot to get through. In terms of timings, just to set the scene, so we've got 90 minutes for the panel discussion this morning. What we'd like to suggest is that we use 60 minutes of that as far as the discussion is concerned, and we're going to leave 30 minutes at the end for Q&A. However, as we go, please do raise any questions you've got, either by just shouting out for sure, or indeed if you would prefer, there is a chat box. And we'd be delighted for you to post any questions in the chat box and we'll try and answer them during the course of the discussion. So before we kick off the panel discussion this morning, let me just start by introducing myself. So my name is Carl Swansbury, partner and head of corporate finance here at RG. And I will be chairing the panel discussion this morning. Let me introduce you to my first panel member, which is Simon Whiteside. So Simon, would you like to just quickly introduce yourself, please?
Yeah, thanks, Carl. Morning, everybody. My name's Simon Whiteside. You met a lot of you already, but I head up our business tax team. In terms of business tax, we look after all aspects of shareholder and company taxation. So the topic of succession is one that we deal with every day, looking at how businesses move around in the ways that Carl described. So a lot of transactional activity, moving shares around a family, etc., etc. So I'll happily jump on board later on the call, talk through aspects as we go along on the tax side.
Thank you, Simon. Secondly, on the panel, I'm joined by Alex Simpson. Alex, over to you for a brief introduction, please.
Yeah, thanks, Carl. Morning, everyone. I'm Alex Simpson. I'm a senior manager within the corporate finance service line at RG. So I've been at RG for around 6 years now, and I've worked on a number of MBOs and sort of succession style transactions. And yeah, we'll obviously look to delve into those a bit deeper from a sort of funding, valuation, deal structure perspective later on in this call.
Brilliant. Thanks, Alex. The third person on our panel this morning is Eugene from NatWest. So Eugene, over to you, please, for a quick introduction.
Yeah, thanks, Carl, and good morning, everyone. So my name is Eugene Taylor, and I lead the NatWest commercial team here in the North East. We look after about 20% of the SME market in the North East. So we've got a good experience of succession and some of the challenges associated with it. Thanks, Carl.
Thank you, Eugene. Great to have you on the panel this morning. And finally, on the panel is Michael Hall. Michael, over to you, please, for a quick introduction.
Yeah, thanks, Carl. Morning, all. So, Michael Hall, I'm CFO of Equality Solutions Group. We're a highly acquisitive consolidator of diversity and inclusion businesses across the corporate, government, and education markets. I've been with the business 4 years. I executed an MBO along with the CEO in December of last year, and we're continuing to to grow on the back of that MBO and funding round, which we'll talk about in a little while.
Thank you, Michael, and likewise, thank you so much for agreeing to be on our panel this morning. So, as everyone hopefully can see, we have a very experienced panel this morning, and we have not only tax professionals, accountants, and corporate finance advisors, but also experienced bankers, and indeed an experienced CFO who has gone through MBOs and acquisitions himself. So for sure, a real diverse skill set. So as we go, please, if anyone has any questions, we'd be delighted to answer them. Just raise your hand, or indeed just shout out if you're feeling a little more bullish this morning. But if you would prefer any questions, absolutely do raise them in the chat box, and we will definitely answer them during the course of the panel discussion. So with no further ado, let me start by maybe asking you, Alex, if you can summarize the key differences between a trade sale and an MBO, so that anyone who is considering either or of those options appreciates the key things that one has to think about.
Yeah, sure. So there's, I think there's a few key areas that we can cover off, just showing those key differences. I think the first one being valuation. So in a trade sale, a trade party usually tend to value a business at a higher multiple than a management team would. And there's a few reasons for that. Usually in a trade sale, there are cost synergies available for the trade acquirer, whereas for a management team, obviously that wouldn't be the case. There can sometimes be a premium to valuation given for a trade party, it could be for fulfilling a specific strategic fit or need. And also as well, an MBO team will require third-party funding, and therefore sometimes they won't be able to reach the valuation levels that a trade party can usually get to. There are also differences in deal structure. So again, usually due to the presence of third-party funding, an MBO transaction is likely to include a sort of deferred or loan note element to the deal structure. And that's usually not paid off until any third-party funding has already been paid off. And that third-party funding will usually take a number of years to pay off. So that deferred element is going to take a bit of time to actually be paid. Whereas on a trade sale, there is still likely to be deferred or earn-out, but that is usually paid off within a sort of 2 to 3 year period. So usually the deals with a trade party are much shorter in length than from an MBO perspective. The next area is, I think, execution risk. So I guess one of the advantages of an MBO is that the buyers are already very familiar with the business and work within the business. In many cases, more familiar than the seller, who has perhaps stepped away from day-to-day responsibilities. So this means that in an MBO transaction, the seller can fairly argue that they shouldn't have to give detailed sort of warranties, and that the MBO team can rely on their own knowledge. And so that means warranties and indemnities are usually much shorter, and there's fewer given in a transaction. And usually, tied into that, the execution risk of an MBO is a bit usually lower than for a trade party. And that's because, unexpected due diligence findings are less likely given the management team are already in the business. A couple of other points I'd just like to bring up. I think funding is obviously a key area as well. Usually a trade party would use their own funds for a transaction, whereas, as I mentioned, management team most of the time, if not all the time, would need to go out and get third-party funding from whether that be a bank or a debt fund or private equity. And finally, I think the MBO team itself, I guess for an MBO to be possible, there does need to be a second-tier management team in existence, and they have to be, experienced, able. The third-party funder has to be able to buy into them, and they also need to be able to contribute capital, which is usually about 1 time salary. But yeah, I think those would be the key differences between a trade sale and an MBO.
Thanks, Alex. And Alex, what about legacy? I guess, often for the shareholders of a business, it's incredibly important that they know that their legacy will be celebrated post-sale of the business. So I guess, what's your view on how a trade buyer may differ to an MBO team in that regard?
Yeah, I guess from a legacy perspective, a seller would probably favour an MBO because you have more of a business as usual transaction. There's less risk around big changes being made in the organisation structure of the business. So from a legacy perspective, yes, a seller might favour an MBO for that reason. And I think there are other kind of legacy transactions, I guess, to think about. There's employee ownership trusts, which I think we're going to come on to later. But I think an MBO was probably where someone would probably favour if legacy was important in their priorities.
Yeah, thanks, Alex. I agree with that. I mean, often when selling a business to trade, there is a risk long term of a rebranding. There's risk of integration. There's risk of redundancy as the cost profile of the business that's been acquired is rationalized. Whereas, of course, in an MBO, those things are less likely, as you suggest, Alex, which is often why, shareholders will want to prioritize an MBO. But of course, as you say, an MBO is only possible if there is an experienced, capable, committed management team who are able and willing to take the risks that are required to ultimately enter into ownership. Yeah. I guess the final point, Alex, is just to acknowledge that certainly, over the last 18 months, within certain sectors, there have been fewer trade buyers. And therefore, actually, sometimes an MBO team is favoured in the absence of a trade buyer. You can't sell a business to a trade buyer, that doesn't exist. Whereas I guess a management team is a ready-made acquirer known to the shareholders of the business that maybe is considering a sale. Simon, Alex talked briefly there about an EOT and how that might be a different way of effectively allowing the employees of a business to take ownership. Could you just explain what an EOT is and what the tax differences are between an EOT and a more conventional MBO, please, Simon?
Sure. I guess if we just start with an MBO, Carl, just to sort of set out implications for some people who won't have been through that already or won't have seen it in detail. Generally speaking, there are 3 or 4 building blocks of the tax analysis to do. First of all, I guess, is, as you both alluded to, what will be the consideration that the founders or the current shareholders and option holders will receive? What form will that take? When will it be received? Will it be current? Will it be deferred? Will it be earn-out? Will it be loan notes? All of those have different tax treatments. We tend to find if you get consideration in the form of anything other than a loan note or shares, so if you roll into a new structure, question mark, do the seller take some small tranche of equity within the MBO vehicle? But if we park the shares, everything else will be taxable, and it's a question of working out how you calculate that tax liability. And then importantly, do we get into business assets disposal relief, which is what Entrepreneurs Relief is now called. So the first 1 million could be taxable at that preferential 10% rate. After then, we expect currently to be 20%. I'm sure we'll come on later to talk about what the tax profile might look like going forward. So that's the seller side of things. The management team side, it's very much care to be taken in terms of how we get the NewCo, the buying company set up. And again, that's to do with, will the sellers take some equity? Will there be need for a rollover and a clearance through HMRC? How will management get their shares? How do we value there? What's the debt coming in? How does that all work? So really, there are 2 or 3 aspects there. There's the funding piece. They all need to go together into a clear plan to make sure sellers get the treatment they want and they understand, but also the new management team coming in, get into a structure so there's no tax leakage on the way in. We make sure there's a management team owning some equity, possibly with some share options or something to bring in some further management as the business evolves. But really, it's that 2-stage process, getting the sellers right, getting the buyers right. Contrast it to an EOT. So in simple terms, an EOT, which isn't simple, is a business that's the John Lewis model you'll have heard of before. And there was a review done probably about 7 years ago now from the government about putting these structures together, which get employees incentivized, hopefully drive stronger business performance because of the engagement of the employees. That's the motivation, and the government decided there should be some tax incentives to do that. So if current shareholders sell a business, to an employee ownership trust, and generally that means a trust. You'll have heard of trusts in lots of different environments, but basically a trust which is for the benefit of just the employees of the business. Probably has a trustee company sat above there where employees and professional directors or whatever may sit there and act on the behalf of all of the employees. And that employee ownership trust must acquire at least 50%, generally 51%, possibly all the way up to 100% of the shares. And if that happens, then the shareholders can pay 0 CGT on that transaction. So obviously that's very attractive from a tax planning perspective. However, there are some cautions. Once you enter into this structure, the business is then controlled by the employees. So if somebody wants to look at an MBO and wants to sell some shares, keep some equity and maybe enjoy 25% of the sort of future value realization, I can see an MBO can definitely move forward into other sort of transactions, other sort of directions. With an EOT, it often feels it's a little bit of a one-way street because you put employees in charge of their own business. It's probably very rare that the trustees would look to sell that business on in any way unless something really interesting, unusual came around the corner. It tends to be a destination, tends to be a place to go to. The second one is around consideration. Although you're taxed at 0%, how do the trustees generate value to pay the selling shareholders out? Sometimes there might be some cash in the business. They can probably access some of that surplus cash. But beyond there, it's probably unlikely that trustees would have an appetite for significant debt. So therefore, compared to an MBO where we can put some leverage in, we can get some value out to shareholders and see a path to realising all the rest of the value, it's sometimes seen as an EOT as paying yourself for your business in lieu of sort of dividend flows and really saying, we'll lock that in, we'll get a favourable tax treatment, but we'll be very patient sellers. So I think they're quite different structures from a planning perspective. I think legacy is important. You've touched on that earlier, Carl. Why might some people go down an EOT route? Certainly if they want to be slightly philanthropic or have an interesting view on how their business wants to be owned for the future, possibly for a long, long time, an EOT is very attractive. But I think although there are some very positive tax benefits, there are a lot of complexities. How do we get the trustees together? How do they decide this is the right thing to do? We can't enfranchise one employee shareholder ahead of the others, really. This needs to be, we're all in it together. So there's some quite different dynamics. Putting a management team together for an MBO is one thing, which we've all seen happen before, and it can be, you put your hands around it quite quickly. With an MBO, it's a little bit different. We need to put this sort of vehicle together, create this idea of a trust, and it needs to be, possibly 50, 100, 200 employees all seen as owning a business together. So quite a different dynamic in terms of how that would come together. There are some tax technical points as well about when you get an EOT, how value comes out to the employees to pay the consideration of a future value. So there's some nuances there, but certainly it's a much more tried and well-trodden path than it was. And we're seeing a number of these happen every year now. And I guess if you gaze into the crystal ball and tax rates move further, but EOTs survive as they are, the level of attraction will probably increase just as that differential could go up over the next 5, 6, 10, 12, 24 months.
Thanks, Simon. That's really insightful. And other than the potential risk of there being an increase in capital gains tax, which could be announced in the upcoming autumn budget, why else do you think it is, Simon, that we're seeing more EOTs now than we maybe did do 2-3 years ago?
I think one thing, Carl, is that they are now more well understood. The execution, we talked earlier about execution risk. I think that was quite high when you were one of the first movers. There is a well-trodden path. There's an HMRC clearance process in terms of how these things work. So I think people are getting to understand them. Back to your other comment, possibly if there aren't the trade buyers out there, do these become a bit higher up the list? They are, I guess, a variation on the theme of an employee-led buyout. They're just a different way of doing it. So there's that, and I think the tax attractions that are out there, and I guess the professional community, now it understands them more. There's probably broader conversations like this going on, Carl, elsewhere, where they're becoming just more well understood and acknowledged. I think there is still that reservation for me that if you can go into a sale and your business is worth 10 million quid, you can get 3/4 of that out on day one and be patient for the rest of it. How does that feel versus taking 10 or 12 or 15 years to get your money out of an EOT structure? They're the sort of things I think people still need to weigh up when they're looking at these alternatives.
Yes, absolutely. I guess there's the time value of money point there. And of course, also the risk for the seller, because the longer the deferred period, the higher the risk that one doesn't receive that consideration is. Thanks, Simon. Really interesting perspective. Obviously, for an MBO or an EOT to be viable, there needs to be a management team in a business, running a business, who's got the experience, the ambition, and the appetite to go from being employed to being an employer and to move into ownership, often for the first time. Eugene, it would be really helpful to understand how you and NatWest, along with other types of debt provider, can support management teams when they're looking to unlock these types of transactions, how you go about establishing what level of funding you can provide.
Yeah, thanks, Carl. So when I was looking to prepare for this earlier this week, I thought it was timely that it coincided with the new HBO series, or Series 3 of Succession, about a dysfunctional and Machiavellian American family who were just intent on really destroying each other. So I'm sure we've got no businesses like that in the Northeast. I'm absolutely certain of that. I just thought it was slightly ironic that I was preparing that at the same time. Listen, I thought it would be useful to give you a feel of how we at NatWest, and I guess this will be similar with other high street banks, look at an MBO transaction in particular. So I would break it down into financials and non-financials. So if I look at the financial bit first, I guess the thing to bear in mind is the business from a financial perspective looks very different post-MBO. So the balance sheet will have some leverage in it, probably highly geared. And a lot of that gearing will relate to goodwill. So as bankers, we don't really attach a lot of value to goodwill. It's not like when someone buys a property for £1 million, we lend them £1 million, and the balance sheet kind of works itself out. You know, we might end up lending a few £1 million for a good chunk of goodwill. So the balance sheet will look very different. It's leverage now, brings in more risk from everyone's point of view, really. The other aspect of the balance sheet that will be different is the liquidity element. So quite often through the MBO process, if there are cash balances sloshing around, some of those will be used to pay the vendor. If there are existing lines of finance, working capital lines, for example, some of those do get used as part of the transaction. It's not always ideal, but that's sometimes what happens. So you find you get a scenario where the balance sheet is heavily geared, liquidity is more of a challenge. So that's a very different scenario, and everyone needs to be kind of alive to that. And funders will normally look for a 3-year payback on any funding, 3 to 4 years, depending on the circumstances. But that's because it's unsecured debt. Now, when you're looking at that, I guess the other things that we really try and work out is what is the sustainable EBITDA? So, you know, if a business is generating £2 million EBITDA year on year, we'll base our ability to lend against that. You know, we may be able to lend £2-3 million, whatever the number is, but we'll base it on the sustainable EBITDA. Broad brush, and this is very, very broad brush, and it will depend. You might look at leverage of, 2 million, EBITDA of 2 million, 1 times is not far off for a high street bank. Can increase slightly depending on the circumstances. The other thing to think about here is the pandemic. So, it used to be relatively easy to work out what the sustainable EBITDA was. You go back the last 3 years, if they're generating, $1 million 1 year, 1.2 the next, 1.5 the next, you might say, well, on average, it's 1.2, 1.3. What the pandemic has done is really mix it up over a 2-year period. Some businesses have done better. The majority have probably struggled a little bit. So trying to add all that back as to what is a long-term sustainable EBITDA has become a little bit harder. But we can work it out, but it's become a little bit harder. The other thing for the MBO team to bear in mind is the debt will have covenants. That will be something that possibly is new to the business. And covenants are just really a way for the bank to monitor performance of the business. But it places a few restrictions on for those 3 years. Now, there are a couple of mitigants that will help here. The major mitigant is, will the vendor take some deferred consideration? And most deals, the vast majority of deals that we see, we lend a couple of £1 million, the vendor's got to take some deferred of £1 million, whatever the number is. That becomes really important because that brings down the gearing, brings down the leverage, increases the liquidity. So something to bear in mind. from the MBO team itself, and this is not crucial in terms of gearing and liquidity, but we do expect some contribution, and that contribution doesn't have to be huge. You know, it might be the equivalent of a year's salary, or it might take the form of a personal guarantee limited to, you know, a relatively small amount. But we sometimes describe it, not very nice in a way, but we describe it as pain money. You know, the MBO team has got to have a bit of money in there, a bit of risk, that if things don't work out, you know, they're still in there fighting to get the money back for the funder. So they're the financial aspects. The non-financial aspects, I think the biggest thing is really around the vendor, the leaving owner. How involved has he or she been in the business in recent years? Have they built up a management team who can run the business without that vendor, without that owner? And most good ones have. Most good ones, you'll see that the person exiting the business has gone down to a couple of days a week, has gradually moved away, has built a team around himself or herself. And that's, you know, that's a really good position to be in. And I think, and I don't know, you know, Carl, you may agree or disagree with this. I think most MBO teams like the owner to have gone. You know, sometimes there's value in them staying in. Sometimes with a trade sale, they'll insist on the owner staying there. But I think most MBO teams want to get the owner gone just to make it their own business. You know, I don't know, Carl, have you come across that?
I think that's right, Eugene. I think that definitely, you know, a management team want to be able to autonomously develop the business in the way in which they see fit. And of course, often, you know, the founder can be very precious and therefore will not allow change. And therefore there can be a natural resistance. And maybe when we pass over to Michael in a moment, you know, Michael can share with us his insights into that same subject, given he, of course, led the MBO of the business, which did see the founder, sole shareholder, exit in his entirety. Maybe for that reason and others.
Yeah, it's sometimes a bit like Banquo's goes to Macbeth, where he's always there, he's always present, you know, even when he's not physically in the building. It does actually, it reminds me a little bit of, I'm going back years, but when Bill Shankly left Liverpool in 1974, he retired, and Liverpool wanted to get on with stuff, but he kept turning up at the training ground, and no one really could say to Bill, you need to go. And eventually Bob Paisley had to say, this is my team now, you know, you need to go. And it was a big thing at the time, but hopefully it's not the case. Hopefully the vendor will take their money and go and lead the MBO team the headroom to manage the business. I think in terms of tips, because, you know, this is, you know, it's naturally a higher risk time than normal, and there are challenges, but I think the tips would be start planning really early. So by that, make sure the MBO team have got access to all the key elements of the business, you know, start taking responsibility away from, you know, the owner manager as such. Start making the links with the key customers if you've not already done that. Get advice early. I think that's really, really important. Now, you know, the vendor will have his or her own advice. I think it's important for the MBO team to go and get their own advice. Hopefully this will be an amicable sale, but inevitably, you know, the advice that the MBO team gets in terms of value, in terms of structure, will be slightly different from what the vendor gets. They've got slightly different, or probably quite big different kind of objectives in all of this. And then the final bit is be realistic. Be realistic on price, be realistic on share of risk. So if you're the MBO team, you're probably going to have to put a little bit of money in yourself. If you're the vendor, you're going to have to probably leave a bit of deferred in yourself. And, you know, and the funder obviously has to take the big chunk of the risk as well. But across those three parties, be realistic in how you structure it and how the risk is shared amongst the three of you. Thanks, Carl. That's what I would cover.
Thanks, Eugene. Some interesting points in there. And I think one point I'd love to just explore a little further is what level of funding typically a clearing bank like NatWest can provide. Because using your illustration of a £1 million adjusted EBITDA business, let's assume that business is valued at 5 times, which means a 5 million enterprise value. If NatWest and other similar clearing banks, Eugene, can only lend a management team circa 1 times of the £5 million value, the bank can only provide a loan equal to £1 million. Are you suggesting that a seller would need to get comfortable deferring circa £4 million of that £5 million value?
Yeah, I think that's an extreme case, Carl. We often find it, you know, where the value might be, I don't know, 2 million, and we may be able to do 1 million, and the vendor may have to defer 1 million. Now, I think in those cases where it's as extreme, that feels like the vendor's taking too much risk there. And in those cases, it may be that it's not for a high street bank, it's for PE or it's for another debt funder to do, who will take on a bigger risk and charge more for it, which is reasonable. So yeah, I think that balance feels a little bit of an imbalance to me. I would normally expect, as a bank, us to take the majority of the debt and the vendor to take a minority. And, maybe it's 2/3 to the bank, 1/3 to the vendor, that type of scenario.
Yes, thanks, Eugene. And Alex, just a question for you. So obviously, Eugene has kindly gave us an insight into how NatWest would be able to support a management team in a management buyout situation. But as Eugene explains, a clearing bank often, will have a particular risk appetite, which means they will not be advancing, more than sort of 1.5 times EBITDA as a cash flow loan. So, Alex, would you mind just summarising the other ways in which management buyouts can be funded outside of the clearing bank environment?
Yeah, of course. So, I think we've seen kind of a lot of funding availability for MBOs, certainly over the last few years, particularly within the, as has already been previously mentioned, debt funds. I think over the last couple of years, there's been a lot more debt funds enter the market. And even with the pandemic going on, they still have a certain amount of capital that they need to deploy by a certain point. So they have been very active, and we've worked with a good number of them. So, for example, we're working with Capel on a number of transactions at the moment. We've worked with Shard a lot in the past, and I think debt funds can usually lend sort of in the 3 to 4 times multiple of adjusted EBITDA, and some debt funds can also lend over a longer period of time. We know that Capel can sort of lend up to sort of 7-8 years, and it's also unsecured debt as well from their perspective. So yeah, there's a few differences between sort of debt funds and others. And then you've also got obviously private equity as well, who could come in. There's still a lot of money sloshing around within private equity at the moment. I think they have record amounts of capital that they need to deploy, and they've got pressure to put that capital to work. So they're also very active as well. So yeah, there's a lot of funding availability, I think, in the market at the moment.
Thanks, Alex. And I think that the point that's come out there is the need to understand the full funding landscape when establishing what is the right way to unlock any type of transaction, because as Eugene rightly said, clearing banks are typically providing loans of circa 1.5 times EBITDA, typically over a 3 to 5 year term, which of course will only be palatable for a very supportive vendor group. Whereas a debt provider like a Capel, like a Shard, like a ThinCats, and there's about 45 debt funds or alternative debt providers in the UK who can deploy debt of between 1 and 50 million. They are going to be more risk hungry. They'll happily deploy sort of 3 to 5 times adjusted EBITDA. And as Alex said, often over a much longer term. We see terms of 6, 7, 8 years. And I think the key point is that often these alternative funders or debt providers actually will not require the loan to be repaid during the term. Often it is only the interest that will be cash paid, with the actual loan being repaid as a bullet at the end of the term, which means a business is not being suffocated from a debt service perspective. So a business can invest in itself and grow, which can be often very important. And the difference between unlocking an MBO and not, bearing in mind, the sellers who built a business over 30 years naturally will want to receive full value and will want to receive a significant proportion of it on completion of a transaction. Just a final question maybe Eugene and Alex, for you both, please. Obviously, we've talked about sort of MBOs, or transactions involving employees who already exist within a business. Could we just talk about management buy-ins, i.e., is there a way of unlocking a management-led transaction if a management team doesn't exist in a business today, but there is a management team out with from a business who arguably could be parachuted into a business to buy a business?
Yeah, I think from a high street bank point of view, Carl, that's much harder for us. If we know the management team, if they're already running a business that we already bank, it effectively becomes a kind of acquisition that we will support, all things being equal. If it's a management team that we have no knowledge of, we've not got huge appetite for MBIs. The track record with the banks is not good over the years. So I think most high street banks will probably step back from that.
Understand. Thanks, Eugene. And that's definitely our experience as well. So Alex, I guess for management teams that are looking to buy a business, but not the business they're in, or indeed, if you are a shareholder, not able to sell or not wanting to sell a business to trade, but you don't have a management team in the business who are able or willing to buy the business. Could we just talk about how an MBI can work and the types of funders who are comfortable supporting MBI transactions?
Yeah, sure. I echo kind of Eugene's comments. It is a sort of tougher transaction, really, given the increased risk involved. A new management team, coming into a business, it's hard to say whether it's gonna work out or not. But yeah, it's you still see many numbers of MBI transactions still being performed. I think going back again to the sort of the debt funds that can some of them can provide funding to these transactions. For instance, Capel have released a new MBI product over recent weeks. So yeah, there are still debt funds out there who would have appetite to look at and to fund MBI transactions.
Thanks, Alex. Appreciate that insight. So just moving on, of course, we've talked a lot about MBOs there. And I think now would be a really great time, Michael, to maybe pass over to you, who is someone who has himself led an MBO and of course is now going on to make a series of acquisitions. So it would be brilliant to understand a bit about EQS and where the group has gotten to.
Sure, Carl. So in terms of the MBO and how we unlocked it, there's going to be a lot of common themes, I think, across the speakers this morning. So Eugene mentioned financials and non-financials. So I'll talk about the non-financials first, because I think that's a key part of just getting to a point where you can actually execute an MBO. So the CEO and I were brought into the business 4 years ago now, 3 years at the time of the MBO, and during that time we'd grown the business really well organically. So taking the business from approximately $750,000 EBIT to north of 1.5. So there was a track record there in terms of the management team and their ability to grow the business. And we also had quite complementary skill sets, so we weren't dependent, solely on the CEO or solely on me. There was a good mix of skills between us. So I've got financial background and I've done acquisitions in the past, and Andy is more of a sales and marketing guy. So there was a good blend of experience amongst the team there, and we'd started to create a decent second tier underneath us who could support us with growing the business as well. We had effectively ran the business for 3 years, so I think that gave the funder quite a bit of comfort as well. The original founder had stepped across to build another business, and we actually had demerged that business out before executing the MBO. So he brought us in quite intentionally to run the business while he was focusing on his new kind of startup venture, and that's what we've done. I guess after 3 years, it was quite an obvious thing for us to do, because we'd grown the business, we'd added a significant amount of value to the original founder. His efforts were focused elsewhere, and actually, it was beginning to get to a point where we needed to be incentivized in order to continue scaling the business. And I think
Michael, sorry to cross you. Just a question: do you think Chris Quickfall, who of course is the founder of EQS and was the 100% shareholder this time last year, do you think he recruited you as CFO, Andy Goff as CEO, and the rest of the management team with the intention of you buying the business?
Yeah, so we always talked about equity incentives right from the start, and I think if you are, as a founder, my advice would be, if you are looking to bring a team in, you want people to be quite forthcoming about that kind of appetite, because that tells you quite a lot about the management team's ambition and skill set. And actually, if you were whichever path you're gonna go down, whether it's an MBO or whether it's trade, actually you want someone with that level of ambition and appetite, because they're the kind of right individuals that are either going to enable you to execute an MBO or provide comfort in the event of a trade sale. And yes, you may take a dip temporarily in terms of investing in that management team, and it is, there's a bit of a risk over whether that will work, but actually when it works, it can pay dividends.
Thanks, Michael. And why do you think Chris, and I appreciate it's difficult to think on behalf of someone else, but I'd just love your perspective. Why do you think Chris, as the sole shareholder of eQuality Solutions this time last year, why do you think he chose to intentionally, bring in a management team who would want to buy the business versus building a business to be sold to trade? Given the point Alex made at the outset around value, i.e. the likelihood of receiving a fuller value from trade than a management team, why do you think Chris would do that?
Yeah, so I think there's 2 points there, and one is around actually who would have been the strategic acquirer for the business that we ran at the time. We've changed the business quite significantly during the time, so there wasn't an obvious strategic trade buyer for the business 3 years ago. There potentially would be now, but that's as a result of the executive team and the strategy that they've developed and embarked upon. And then I think secondly, as we got it to the point where actually it could be interesting to a strategic acquirer, clearly we had benefited Chris in a number of ways. So we'd grown his business, we'd scaled it, we got it to a point where it actually was more valuable, and the relationship was very healthy. So there was almost an element of Chris wanting to reward the management team for growing his business. And I think this is a really interesting point about execution risk, that it can be, management MBOs are definitely lower in terms of execution risk, but it also needs to be considered, if the MBO fails, then where are the management team left? So I think if you are going to embark on an MBO process, you need to get certainty quite early on that this is actually going to be a transaction that can work. So I think taking the right advice is important, ensuring that the management team are willing to stick their hand in the pocket and pony up, and can pony up, I think is another key point. So you need to get those things really out quite early on in the process, because actually if for whatever reason the MBO had failed, then it wouldn't have been anything from our perspective, but say we couldn't have agreed the right price or anything of that sort of nature. That would have been really difficult as an MBO team to then go back into the business and continue running the business as an employee once you'd started thinking about ownership and running the business and a future strategy that looks that is management's, not that of the original founder.
And final question, Michael, is around funding. So obviously, we talked earlier about how clearing banks can support management teams in funding MBOs. And as Eugene said, the ability for clearing banks to provide debt of more than 1.5 times EBITDA is a challenge.
Yeah.
So could you just, to the extent you can, could you just maybe give everyone an insight into how you went about funding the MBO of Equality Solutions?
Yeah, so the first thing I've dealt with Carl for a number of years. So the first thing I did was pick the phone up to Carl and start talking about what it is that we wanted to achieve and what all stakeholders actually wanted and needed out of the transaction. And that's a really important point, that the needs of all stakeholders are well understood at the outset. Carl and his team went about a very full market exercise, and we did get a lot of interest. I think there's an element here of just understanding why advice is so important. So I think where the likes of Carl come in, they're twofold really. Are one, around getting access to funding that you wouldn't be able to get as a management team on your own, and by that I mean there are certain funders that will only deal with advisors, and certainly the advisor that we secured in the end, we would not have been able to secure on our own. So that's definitely one thing that we wouldn't have been able to do without a really good advisor with that network. And secondly, as friendly and as amicable as the MBO was, and those relationships still are, there are undoubtedly, as you go through this kind of transaction, some excitable moments, and actually having that independent person that can just navigate their way through those challenges unemotionally with each stakeholder is absolutely vital.
Yeah, that's right. I think often an MBO initially is a very positive concept, and of course, as you say, Michael, the shareholders would only want management to take ownership, right? But of course, there is a very quick conflict of interest that arises because the seller wants full value yesterday, and the management team can't often deliver that. So you're right, the need to have an advisor who can appreciate what stakeholders want, but then actually explain in a very considered way what's in the art of the possible is essential. And in terms of the funder who has supported the MBO, could we just talk a little bit about that and how they went about providing leverage in excess of maybe what you would have obtained from a clearing bank, Michael? Yeah,
so originally we went out to market for to fund the MBO and possibly have a little bit of loose change to maybe do one or two deals, and we did manage to find a deal to run alongside the MBOs. If doing an MBO wasn't enough, we decided we wanted to throw an acquisition in there and do that at the same time as well, which was a lot of fun. But yeah, fundamentally, the funder that we went with, Shard, I mean that's in the press, so I'm not sharing anything I shouldn't be here. But they came along asked a lot of questions very early on, so stood out from the 14 other funders that I think we had meetings with, and asked a lot of questions, wanted to understand the business quite soon, but then once they got that understanding, very quickly challenged us to think bigger. So rather than just providing the capital for the MBO and the transaction, actually saw the market opportunity, saw we were a management team that could execute on that opportunity, and effectively said to us, if we gave you more money, could you go faster? To which we said absolutely, and that was one of the reasons why we ended up going with Shard. They really backed us. They got the whole plan, they got the strategy, they really liked the team, and they were very forthcoming with how they were going to support us. I think the second point around debt funds is, and I think it's really important to understand actually what the strategic plan looks like, because if that involves M&A, then trying to repay capital for an initial MBO on debt alongside doing acquisitions would be really challenging actually from a cash flow perspective. So that bullet structure that Carl mentioned is great for us because yes, it's definitely more expensive than a clearing bank, but actually we are still a cash generative business. we're able to acquire businesses at quite a pace that we wouldn't be able to do if we had a repayment debt structure. And actually, we're able to generate much more shareholder value than the difference between an interest rate, a differential of 5 or 6% on an interest rate. We can add significantly more shareholder value to the business, so we can grow the business much faster with that kind of funding structure. So almost the cost of capital isn't the driver; it's what we can do with the capital that's available to us and how quickly we can scale the business thereafter.
Thanks, Michael. I guess that the point that's really important in what you've said for me is, completing an MBO is one thing, but that's just the start of a new chapter for the business. And you need to make sure that you have a clear business plan and the funding you need to be able to grow and develop the business. Because there is no point a management team buying a business to solely exist to service debt. That's not very aspirational, and nor is it actually going to create much value for that management team in the short to mid-term, at least. Michael, final question for you. And again, conscious that part of this is difficult to discuss in this type of open forum, but obviously when you, as part of the management team, bought eQuality Solutions last December, the business at that stage was a business that had only grown organically. It was a business maybe doing, 1.5 million of EBITDA. Could we just talk a little bit about, where the business has come post the MBO, and what the plans are in the future? Because of course, succession is very much at the helm of those plans.
Yeah, so we, as I mentioned earlier, we acquired a business at the same time as executing the MBO, so that really got us off to quite a positive start. We spent the last 6 months getting really clear about what the M&A strategy is, and that is kind of razor sharp now in terms of what we're embarking on. We completed another acquisition in July. We are about to complete another one this week, and there'll be a further 2 acquisitions to complete by the end of the year. So we've scaled the business from revenues of 6 to a run rate of in excess of 15, and we've actually built a really healthy pipeline that would see the business double again probably in the next 12-18 months thereafter. So it's a very different business to what it was a year or so ago, and certainly a very different business to the business that Andy and I came into. We speak very openly about succession as an executive team in multiple ways. So there's an age differential between Andy and I. We talk very openly about what we would like our plans to be, and I think it's really important that you've got that level of trust and dialogue at executive level. I think we've all got to be honest about where our skills are as well, and that's there have been discussions that we've held over the last couple of years, and we're also adding to that team as we scale. So recently we've brought in a very experienced group FD who's scaled businesses way beyond what Andy and I have scaled before, which allows us to focus more on the kind of strategic components of the business, what we're acquiring in the next round, what we're doing with integrations and ops, whilst making sure that all of the infrastructure piece is taken care of. So not being afraid, I guess, to bring people in who can perhaps do elements of your job better than you, and not having not being scared to do that, I think, is and being open to bringing in new people into the team that I think you can be quite precious about. I mean, Andy and I have worked together for the last 4 years. We can finish each other's sentences, so to actually bring another, and have a very trusting relationship. So to actually bring another person into that dynamic can be a bit daunting, actually. But now we've brought in another. We feel the same about that third person and bringing the next person in. But we know it's just something you've got to do as you mature. Running a 6 or 10 million pound business is very different to running a £30 million business, and you've just got to be sure that you continue to evolve as a management team and you're bringing in the right skills for the next part of the journey. And we're always very honest about the things we can and can't do, or the things that others could do better.
Thanks, Michael. And what an incredibly inspiring 12 months, eQuality Solutions has had, to go through an MBO, to go through a debt raise, to go through 2 acquisitions, and of course the third, which will complete this week. I guess the only downside of that is definitely, as a consequence, I've aged 10 years in 12 months, Michael, so I am grateful for that. But other than that one nuance, yes, very exciting for sure. And given I know what the plans are for eQuality Solutions, I suspect the next 12 months will only be a reflection of what we've achieved thus far and more. Thank you, Michael. Simon, given the fast approaching autumn budget, it would be fascinating just to understand what you think we might hear from the Chancellor and how that could positively or negatively impact corporate transactions whereby one is considering selling shares in a business to a third party, be it a management team or a trade buyer.
Yeah, thanks, Carl. As some of you may be aware, this time next week or afternoon of the 27th, the autumn budget will be delivered. So Rishi will stand up and tell us what we're going to sort of see coming up from here on. I think that's been slightly preempted by the announcement. I think it was the 7th of September with the Health and Social Care Levy. You'd be aware of the sort of 1.25%, probably times 2 on most people, national insurance, plus on distributions, dividends. So I guess that feels like a toe in the water. The government looking to say we've got to raise some more money. How do we do it? And certainly health and social care being one of the areas that needs a big boost, and that's already happened. There's obviously been a lot of speculation. Certainly last March's budget, we were doing a lot of work with Carl's team and others in terms of transactions that were looking to close and execute before the last budget in sight of potential increases, certainly in capital gains tax. That sense of risk of the rate increasing is there. There have been reports provided to government and treasury by independent bodies looking at how capital gains are levied, what incentives are out there and how they could possibly change to increase revenue collection. I think the other side of that coin is to say that actually there've been quite a lot of changes already, whether it's people's relief for their home, residence relief, or entrepreneurs relief turning into business assets disposal relief, now at £1 million. There's a lot of changes already happened, and will, question mark in my mind, Rishi sort of leave that alone just for now, maybe making some sort of suggestions, as we've had already, that the direction of travel is only going to be in an upward direction, but possibly leaving it as it is for now with an eye on next March and beyond. And I think one of the reasons to do that is because actually the receipts will flow. We saw last springtime a lot of transaction activity where actually the Exchequer benefited because people cashed in okay at today's rates, but that was actually a fundraiser. So I think we're always wary. We wouldn't be saying, sitting here this morning, that rates won't go up overnight on the 27th. I would be personally very surprised if they did. I think people can look towards next March, giving them a runway, if you like, Carl. That's probably one way of thinking about it, to say, we know where we are. We hopefully will know where we are next Thursday morning, having listened to the Chancellor and read his documents behind the scenes. But I think the idea is, if you can get something moving, if one of these transactions, an MBO, an EOT, a trade sale, could happen for a business between now and next March when he'll next stand up, I would say there's definitely something to aim for there, because we can't guarantee these things won't move substantially. They tend to start dripping out information through the Sunday Times and the Times when we've seen things coming. There definitely is some sort of test of waters and see what the feedback is. It's been very quiet. That's all I would say. In the last 2 weeks, it's been pretty quiet, which is possibly another reason why I'm saying that next week might be not too much, but will probably signpost what's coming. So there's obviously a lot of other areas at risk as well, and we'll probably find out a bit more about business rates and climate initiatives and all those other things, which I think are very much high on agendas at the moment. So I think that's kind of crystal ball gazing as far as I can, Carl.
Sure, thanks, Simon. And sorry, I'm going to press you a little further.
Yeah, go on.
I apologise in advance for asking such a direct question, but it is a question that I'm asked daily, and I'm sure there's many people on this call who are wanting also to understand what is likely, accepting that we do not know today. So obviously right now, if you were the sole shareholder of a business and you qualify for business asset disposal relief, of course, you will pay CGT at 10% on the first million and 20% thereafter in terms of capital gains tax. Thinking ahead, Simon, where do you think that's likely to end up? So that one who is considering a sale of the business in the next 12, 24, 36 months appreciates how tax could impact their post-tax proceeds?
Sure. I mean, if you take the reports that have been provided, and there have been 2 different reports provided to government in the last 12, 18 months, they have all looked at capital gains in light of should the gap between that and income tax rates be closed/removed. So I think the extreme answer is, would capital gains tax rates end up at the same level as income tax rates? My personal view is that doesn't really incentivize business owners to grow a business and realize value and employ people and pay VAT and all the rest of the things they would do. So I'd be very surprised if the 2 ended up the same. But would you consider a capital gains tax headline rate where 20% becomes, say, 30%, halfway between there and the 40? The numbers are virtually impossible to call out, Carl. The extreme is to say we know what we have now. We know it could be 40, 45%. It could just fall into marginal income tax rates. The 2 could just be tuned together. I'd be very surprised. That doesn't feel like it's a good thing to do to incentivize people to grow, to do what Michael and his colleagues have done with their business. You would probably still want to do that, but you'd have to be almost looking at holding that business forever, because you'd look at a dividend stream and a return and all the rest of the things, as opposed to giving you an incentive for long-term investment and value realization. Other tweaks could easily be, do you have to own a business for 5 years, not 2 years, before you drop into these beneficial regimes? There are other tweaks you could see happening here to make people work a bit harder to realize their value. But I think the more likely is that if we do see a CGT uplift, it will hopefully be still a stepping stone between capital gains and income tax rates. I'd be extremely surprised if it goes all the way to the top.
Thanks, Simon. I appreciate that clarity at a time where we have no certainty, but that's a really helpful response and provides a bit more colour than maybe we had just moments back. So thank you, Simon. Alex, just a quick point to sort of reflect on with you. Obviously, over the last sort of year and a half, businesses have had to contend with COVID. We've also had Brexit to deal with, certainly for those of us who import/export. Just wondered, despite those bumps in the road, if we call them that, why do you think it is we still have seen a significant increase in transactional activity, whether that be MBOs, MBIs, trade sales? What do you think is driving that, save for the point you made earlier, which is that there is a significant amount of dry powder in the funding market, whether it be PE or debt funds?
Yeah, so as you said, we haven't really had much of a sort of downturn in terms of activity, M&A wise. Obviously there was that month or 2 straight after sort of March 2020, where no one really knew what was going to happen, where a lot of things got put on hold, but then everything kind of got back to business as usual very quickly when people realized that the world still needs to go on. But yeah, I guess in terms of why we're seeing this big uptick, I guess there is that, obviously touched on it earlier, the threat of the change in tax rates, potential increase in capital gains tax. There was that potential for that to be increased in the March budget. So, in the run up to that, there were more people thinking about, selling on their shares. I think, there's been an increase in MBOs, partly due to some trade buyers wanting to focus on their business rather than acquiring a new one, in terms of, focusing on organic growth rather than growth by acquisition. And perhaps, also, just COVID putting things into context, making people think about the bigger picture and maybe just deciding it was time for a change. I think those reasons, also obviously the funding availability in the market, as I mentioned earlier, is fueling quite high amounts of M&A activity.
Thanks, Alex. And I guess the other things for us all to also be mindful of is the fact that, many sectors have performed incredibly well as a consequence of COVID. So businesses in the technology sector, likewise healthcare, transport and logistics, and therefore actually maybe shareholders have decided to take those businesses to market as a consequence of those businesses performing incredibly well, and therefore being able to lock in capital value based on that significant uptick in performance. I think definitely we've also seen a lot of distressed M&A. So of course, if you are a well-funded business and are acquisitive, I suspect there have been opportunities to buy great businesses that maybe have lost their way, or as a consequence of being undercapitalized, have not been able to come out of the other side of COVID in the way in which maybe a better funded, larger business has done. So definitely we've seen a lot of distressed M&A, and I suspect, Q2, Q3 next year, that will only continue to be the case as more and more businesses start to really feel the effects of COVID, as all of the CBILS loans, all of the deferred VAT starts to really become pertinent when it comes to the repayment of those facilities. I think definitely the other thing we've seen is that a lot of large international corporates have had an opportunity to look at their group structure and, where relevant, divest non-core. So regionally, we advised on the management buyout of Komatsu UK, and that's a really good example of a large corporate, Komatsu, deciding to divest their UK operations as a consequence of Brexit, and them no longer seeing the UK as a strategic priority geographically, which of course gives the management team in Sunderland of Komatsu the greatest opportunity to take ownership of that business. So I do think that a lot of corporates are divesting non-core assets, which again is probably why we're seeing a real increase in M&A activity, but in particular management buyout. I think the last thing that definitely we're seeing when it comes to transactional activity is the acknowledgement of the fact that there is a real risk of significant inflation, and there is a real risk next year of an economic downturn, which of course could have a negative impact on buyer appetite, on financial performance, all of which goes to value. And therefore, I think that is encouraging certain shareholder groups to transact now, whilst they have certainty of value and an ability to transact at a time whereby capital gains tax arguably is at the lowest it will be at for some years ahead, given the potential changes that may be announced in the autumn budget. I think at this point, I'm just going to maybe ask one final question of the panel before we move into a very brief Q&A. I promised at the beginning we would send you on your way by 10 a.m. sharp, and I will absolutely do that, conscious everyone has busy diaries, I'm sure. So just a question for the panel, please, at large. If there was one piece of advice you would give shareholders or a shareholder who is considering positioning their business for a sale, what would it be? And I appreciate we've covered an awful lot, but it would be great just to deliver one final takeaway. So maybe, Michael, I start with you.
Build a good management team, undoubtedly. We see this in the acquisitions that we're making, the difference between businesses that have prepared and brought in professional management. The difference between those businesses and the businesses that have been typically founder-led or founder-led only. Founders can lead businesses alongside experienced management, but it's all about the team.
Thanks, Michael. And of course, you are a part of that team. So I absolutely agree. Developing an experienced management team is absolutely essential.
Yeah, but we see it in the businesses that we're acquiring as well, Carl. There's just so much benefit from both selling from a trade perspective and an MBO. It gives you both of those potential options, but you will build value by bringing in an experienced management team. And if they don't deliver value, then they don't survive.
That's right. And of course, that's really relevant, isn't it? For any business, because whether you are anticipating a trade sale or whether you are looking to position a business for a EOT or MBO transaction, I mean, fundamentally, unless there is a team in the business who run the business who are competent and capable, then there is unlikely to be any corporate transaction, because no funder will support them and no buyer will appreciate that they have the ability to scale a business. So I think you're absolutely right. A lot of SMEs are founder, shareholder run, and those SME business owners do not appreciate the essential importance of having an employed management team beneath maybe the shareholder level. And of course, that succession will create value. Without it, arguably, there'll be no value realization event for those shareholders, which is why there are so many aborted transactions in the sort of SME part of the marketplace, because often the privately owned businesses are great businesses, but so dependent on the shareholder founder that it's impossible for that individual to extract that capital value when there is an opportunity for an M&A type transaction. Thank you, Michael. Alex, what's your sort of one takeaway, please?
Yeah, I guess it would be to, speak to people who've been through this before, who've got the experience, bringing in, advisors who have been through this process many times, because I guess, no one business is the same. You'd need to, one certain transaction could be perfect for one business, might be not so perfect for another. So I think, bringing in that sort of key advice just to, before, you push the button on any sort of big decisions, I think would be key and vital, just to make sure that you're going down the right road.
Thanks, Alex. Appreciate that. Eugene, what would your one piece of advice be to a shareholder or a group of shareholders, considering a transaction in the future?
Yeah, probably just linking into Michael's point. Certainly from a vendor perspective, plan early. What we do see is we see events often outside of the business make a vendor decide, actually, now I want to sell, and haven't really done any planning before that. We've seen a little bit of that through the pandemic. People have thought about life changes and I want to sell now, but they've done no planning before that. So plan early. This can take years to get this in place, to get the management team in place, to talk to advisors. So plan nice and early. That's all I would say.
Thanks, Eugene. And Simon, over to you.
Yeah, echoing the other comments, Carl, it's planning, but my planning would be very much looking at things like the equity ownership of a business. So if you've got a series of founders, do they own it in a way which is maximising capital gains tax relief? Do they spread what's not entrepreneurs relief anymore, but that's what we understand more broadly. If they're thinking about a management buyout, is it right to sort of get some equity into management's hands sooner, or actually is it right to hold off and do that at a later point as part of the MBO? Certainly, if we're thinking about incentivising management to grow towards a trade sale, they're often more attractive where the management have some sort of EMI options or something like that, so they're really bought into a value crystallisation. And the final one is, if your succession plan is more likely to be intergenerational, don't wait. Look at that, look at the opportunities. When can you move shares around? How can you move them around? How do you make sure everybody's totally bought into that process? Or similarly, if there's certainly we've talked to a lot of clients where they realise a very big trade sale or some value realisation, actually there's planning to do with the equity into a family trust structure, whatever it might be now, while you can get into those release, while we understand the tax regime. So really it's planning, but I think with an eye on the equity and making sure that if the value does get realised, it's realised by the right people, and you can't do that at the last minute. We have so many transactions which have problems when we're trying to move equity around too late. So, give yourself a couple of years. Like Michael said with Chris, he did that. He got the management team right. He had a plan that was a number of years out. I think Eugene said the same. That's my advice is, think about that from a planning perspective nice and early.
Thank you, Simon. So just to summarise before we move into a very brief Q&A, I think the key thing that's really important for any shareholder, any founder, is to acknowledge the fact that one can spend a lifetime creating a business. And therefore it's essential, isn't it, that one spends the time to make sure that the business is well placed to be able to realize at the right time the value that the shareholder or shareholder group has created. And of course, the absolute priority there has to be to make sure the shareholder group understands what the options are, be it a trade sale, be it an MBO, be it actually some sort of EOT, and then positions the business accordingly to make sure that that transaction is possible. And I guess in terms of RG, we are one of the largest independent advisory firms here in the Northeast. And within our corporate finance business, in the 12 months to the end of July, we advised on 42 transactions, many of which in the Northeast, many of which involving, selling regional businesses to trade acquirers, advising management teams like Michael at Equality Solutions on the acquisition of the business that they have spent so many years building. And as a consequence, we would be delighted to speak to anyone at any time, just to make sure that we understand what it is the shareholders are trying to achieve, and indeed, therefore, what is in the art of the possible and what needs to be done to improve the probability of the shareholders' aspirations being achieved. So I think at this point, I'm just going to pause and ask if anyone has any questions or any particular points that they'd like to bring to the panel for discussion and debate. Super.
Carl, it's Chris. Just to fill the silence, can't believe
Indeed.
that. First of all, thank you all very much for a brilliant discussion, which I'm sure everybody found very good. Can I just ask one question, touching on the point that I think it was Eugene referred to, vendor loans, which obviously have the benefit of reducing the gearing in a transaction. What sort of security or guarantees have you seen that are available to the vendors in transactions to help those to facilitate that sort of structure? Or do you just see them as being completely unsecured without any form of guarantee, bank guarantee, for example?
So, Chris, normally there wouldn't be a bank guarantee. So what we've seen, what we normally ask for, we would normally say, if we lend over 3 years, whatever the vendor leaves in, they don't start to get repaid until after year 3. However, I've seen transactions where the vendor will tie something in to say that if the new owners default on the vendor loan thereafter, the vendor can come back in and reclaim their shares. So we've actually seen that in a case a few years ago. So that's really I think that would be the main plank of security the vendor might get, that they build something in that means if there's a default on the loan, they can come back and take the shares. It's a disastrous situation actually when that happens, because normally the vendor doesn't want to come back in, and certainly the MBO team don't want to lose what they put in. But I don't think beyond that there's any other guarantee. It's a genuine risk to the vendor that they're leaving some money in.
Yeah. I think that's right. And Chris, that's why it's incredibly important that the shareholders believe that the management team they're selling the business to has the ability to grow and develop the business, because if not, then of course the seller naturally is risking that vendor loan note never being repaid. In 95%, Chris, of the transactions we advise on, whereby the MBO is being debt funded, be it by a clearing bank like NatWest, or be it an alternative lender like a Capel, in every instance, the vendor loan note or any deferred consideration owing to the vendor will be fully subordinated to the senior lender. Often what you'll have is an agreement with the seller that the loan note will be redeemed over a particular period of time, often with interest. But of course, it will always be subject to covenant compliance. And therefore, if the business's performance softens, if the debt provider does not feel confident that their debt can be repaid alongside the vendor loan note with headroom, then sadly it will always be the vendor loan note or the deferred that will be pushed out.
Yeah. Okay. Thanks, Carl. Thanks, Eugene.
Thanks, Chris. Any other questions from anyone before we wrap up this morning? Super. Excellent. Well, we've managed to come to a close with 8 minutes spare, so plenty of time for people to visit the bathroom, grab a coffee before, I'm sure, your 10 a.m. start. So on behalf of myself and the panel, thank you very much for joining us this morning. We hope you've found it interesting. We hope you've been able to take, one or two snippets away, which will help you as you go about positioning your own business for a potential transaction. If you're a member of a management team, you maybe have now a better appreciation of the things that you have to be thinking about. And then, of course, to those advisors on the call, maybe you've been able to just pick out one or two areas which you may agree from experience are incredibly important when considering change in ownership type transactions. Well, for now, huge thanks to everybody who's joined us this morning. It's been great to see many friends, many familiar faces during the call this morning. Naturally, if anyone has any questions for any of our guest speakers, then please absolutely feel free to contact us via email and or LinkedIn. But for now, I wish everybody a successful Wednesday and no doubt look forward to catching up with you all separately in the coming days and weeks.